A 50% drop in Bitcoin's price doesn't break the market. Poorly structured leverage does. When collateral values collapse, the difference between a secure loan and total liquidation comes down to a few critical variables. If you don't understand them, you are the yield. Here is how the mechanics actually work. In a market built on noise, this is structure, digital credit explained. In the previous episode, we examined Bitcoin's distinctive properties as financial collateral, its fixed supply, issuer independence, continuous liquidity, on-chain verifiability, and the volatility that must be actively managed. Today, we trace the mechanics of Bitcoin-collateralized lending from the moment of origination through the full life cycle of the loan, with particular attention to the moments of stress where those mechanics are tested most severely. A Bitcoin-collateralized loan follows a structure that should be familiar to anyone who has worked with secured credit, but with characteristics that distinguish it meaningfully from a traditional margin loan or a real estate mortgage. Here is how the mechanics work. A borrower who holds Bitcoin deposits it as collateral with a lender. The lender confirms receipt of that collateral, ideally verifiable on-chain, and extends a loan. The loan is typically denominated in a fiat currency or a stablecoin pegged to a fiat currency. The borrower pays interest on the loan principal for the duration of the arrangement. At maturity, the borrower repays the principal plus accrued interest and receives the collateral back. If the borrower fails to repay, the lender has a claim on the collateral. The first critical variable in this structure is the loan-to-value ratio at origination, which we introduced in episode 2. If a borrower deposits Bitcoin worth $100,000 and receives a loan of $50,000, the initial LTV is 50%. That 50-point buffer between the loan value and the collateral value is the lender's first line of protection against declining collateral prices. The second critical variable is the liquidation threshold, the LTV level at which the lender is contractually permitted to begin selling the collateral to protect the loan. If the loan agreement specifies a liquidation threshold of 80% LTV, and Bitcoin's price declines such that the collateral value falls from $100,000 to $65,000, while the loan remains at $50,000, the LTV has risen to approximately 77%, approaching the liquidation threshold. If prices continue to fall and the threshold is breached, the lender may liquidate a portion of the collateral to bring the LTV back within acceptable bounds. This mechanic, the relationship between LTV, price movements, and liquidation, is the central risk dynamic of Bitcoin-collateralized lending. It is why the origination LTV matters so much. A lender who originates at 50% LTV has a much wider buffer than one who originates at 75%. And it is why market velocity matters. A slow, gradual decline in Bitcoin's price allows time for margin calls and partial liquidations. A rapid price collapse, of the kind Bitcoin has historically demonstrated in certain stress periods, can eliminate the buffer faster than the lender can act. Between the origination LTV and the liquidation threshold, many lenders insert a margin call threshold, an intermediate LTV level at which the borrower is notified and asked to deposit additional collateral or repay a portion of the loan to reduce the LTV back to an acceptable level. This gives the borrower an opportunity to prevent liquidation before it occurs. There is a further structural variable that is critical to understand in the evaluation of any Bitcoin-collateralized lending arrangement: what the lender does with the collateral between origination and maturity. A lender who holds the collateral in a segregated custody arrangement, where the Bitcoin is demonstrably not deployed for any other purpose, presents a materially different risk profile from a lender who rehypothecates that collateral, that is, who uses it as security for their own borrowing or deploys it into other income-generating activities. Rehypothecation amplifies returns for the lender, but it also creates additional risk layers for the borrower, because the collateral is now exposed to the lender's own counterparty relationships. Understanding this structure, Origination LTV, margin call threshold, liquidation threshold, and collateral disposition, is the foundational analytical framework for evaluating any Bitcoin-collateralized credit instrument. These are not abstract variables. They are the specific terms that determine whether a lender's position is genuinely secure or only appears to be. Bitcoin-collateralized lending is a secured credit instrument with a specific and analyzable structure. The LTV at origination sets the collateral cushion. The liquidation threshold determines the lender's protection floor. The margin call mechanism is the early warning system. And the disposition of collateral, segregated or rehypothecated, determines whether the structural protections are real or illusory. Each of these variables can be evaluated with precision before a single dollar is committed. That is the discipline this series is designed to build. In the next episode, we turn to the second building block of digital credit, the stablecoin, and examine the mechanics that determine whether a dollar-pegged digital instrument is genuinely stable or merely appears to be. Clarity before yield, always. Digital credit explained. Digital credit explained.